So, you just dropped some serious cash on new hearing aids, or maybe some fancy new glasses, and you're thinking, great, at least I'll get a nice little tax break for this. Well, what if I told you that for millions of people, that tax benefit just, poof, vanishes into thin air? Today, we're diving into a really sneaky mathematical trap in the tax code, and more importantly, the strategy you can use to make those big medical costs finally count.
So let's just ask the question straight up. Are your hearing aids and glasses completely invisible on your tax return? For most of us, especially those who take the standard deduction, the answer is a shocking yes. And it's not because they aren't technically deductible. They are. It's because the system has this financial obstacle course set up that makes those deductions disappear before you even get a chance to claim them.
You know, the best way to think about the standard deduction isn't as a shortcut, but as a giant fortress. Seriously, it's this massive financial wall. And whether it was designed this way or not, its main job is to keep regular people from getting any real benefit from adding up or itemizing their individual expenses, especially medical ones.
And when I say this wall is massive, I mean it's huge. For a married couple over 65, the standard deduction for 2025 is going to be around $34,700. That's the number. That's the wall you have to breach. If all your itemized deductions, that's your state taxes, any charitable gifts, and your medical costs, if they don't add up to more than that number, then all those individual expenses give you exactly zero tax benefit. Now, the standard deduction is sold to us as this great simplification, right? And for some people it is. It's a default, one-size-fits-all number. No need to keep a million receipts. But here's the thing. That convenience can be an incredibly costly trap, especially if you have high out-of-pocket medical bills. By taking that default option, you could literally be leaving thousands of dollars on the table. But wait. It actually gets a little worse. Before you can even try to get over that fortress wall, the system puts two other hurdles in your path. And this first one, man, this one trips up almost everybody. It's called the 7.5% AGI Floor. AGI just means adjusted gross income. But here's what it means in plain English. The IRS says that the first 7.5% of your income that you spend on healthcare just doesn't count. It's like it never happened. It gets completely erased. Only the money you spend above that line is even allowed to be part of your potential deductions. Okay, let's look at how this plays out. Say you're a couple, your AGI is $100,000. That means your 7.5% floor is $7,500. This year, you spend $6,000 on really good hearing aids. So how much of that can you deduct? Well, as you can see right here, absolutely nothing. Your entire $6,000 expense gets swallowed up by the floor. You haven't even made it to the starting line of the race. So here's the really crucial takeaway. When you put that 7.5% floor together with that enormous standard deduction fortress, for most of us, in most years, our medical spending becomes strategically worthless from a tax perspective. Spreading those expenses out pretty much guarantees they'll become tax invisible. The only way to win this game is to completely change how you play. So, how do you breach the fortress? Well, you use a really smart strategy known as bunching, or what some people call the Sawtooth Method. This is all about taking back control of the timing of your expenses to basically force a win for yourself. The idea is actually pretty simple, but it's so powerful. Instead of just letting your deductible expenses happen whenever, spread out over several years where they never add up to enough to matter, you strategically consolidate them. You create one super year of spending on purpose to create a huge spike in your deductions. Here's the game plan, usually over a 3-year cycle. In year 1, that's your on year, you pull forward and stack every controllable expense you can think of. Elective surgeries, charitable donations, new medical gear, anything. The goal is to blow right past that standard deduction. Then, in years 2 and 3, your off years, you do the exact opposite. You spend as little as possible on anything deductible and just take that big, simple standard deduction. This chart shows you exactly what we're talking about, that sawtooth pattern. See it? Instead of having 3 kind of small, useless years of deductions, you get one massive, super effective year, followed by 2 years where you just chill and take the easy route. You're basically getting the best of both worlds just by being strategic. All right, let's make this real. Let's look at a side-by-side comparison to see the actual financial difference this makes. We'll compare a passive spender, who just kind of pays bills as they show up, to an active buncher who plans this stuff out. This is where it all clicks. Okay, let's walk through the numbers. Both couples have a $100,000 income. The passive spender buys the hearing aids 1 year and knows they need dental implants next year.
In both years, their itemized deductions just don't add up to enough, so they take the standard deduction. Their medical spending gets them nothing. But our active buncher, they're playing chess. In their one super year, they buy the hearing aids, they prepay for the dental implants, and they bunch 3 years of their regular charitable giving. Their total medical spending hits $22,000. After you subtract that $7,500 floor, they can still deduct $14,500. You add that to their state taxes and their bunch charity, and their total itemized deduction is $39,500, way over the standard deduction. Boom, they've breached the fortress.
So what's the actual payoff? What's the bottom line? By bunching their expenses, the active buncher unlocked an extra $4,800 in deductions in that 1 year. That is a deduction that passive spender just threw away by not having a plan. This is real money, real tax savings, all from just being smart about when you pay your bills.
Now, pulling this off, doing it right, really comes down to one last crucial rule about timing. If you understand this one little detail from the IRS, it can make all the difference between a successful bunching year and one that just falls short.
And here it is. This is your secret weapon, and it comes directly from the IRS. A medical expense counts as paid the second you charge it to your credit card. So what does that mean? It means you can pay for a dental procedure that's happening next January, on December 31st of this year, and you get to claim the deduction for this year. This gives you incredible power to pull future expenses into your super year.
And remember, this whole strategy isn't just about hearing aids. This bunching mindset works for any deductible expense that you have some control over. We're talking major charitable gifts, other elective procedures like getting LASIK, prepaying property taxes if your state allows it, the list goes on. It's about looking at your whole financial life and finding those opportunities to consolidate and win.
So, this leaves us with a final, bigger question. The standard deduction is just a default setting in our financial lives. That, as we've seen, doesn't work for everybody. It makes you wonder, right? What other defaults are out there in your finances that might be costing you money? Of course, everyone's tax situation is unique, so you should always talk to a qualified tax professional to see if a bunching strategy is the right move for you. Thanks for tuning in.